Hey everyone, JPA Trades here. At it with another YouTube video. So before we get started, I just want to say thanks to all the new subscribers for coming. Thanks for all the likes, leaving comments. It means a lot. It really helps to grow not only the YouTube channel but grow the Twitter channel as well. So just want to say thank you to Team Algonaut. Thank you for always kind of being out there, keeping everyone engaged, keeping everything going. It means a lot to me, and if you want to keep doing it, that'd be awesome. So let's get into it with supply and demand zones. So, as always, I like to start these videos out with assuming that everyone knows nothing, and then just kind of building that nice base knowledge for you guys, and then giving you the tools needed and that information needed so you can kind of go off and be dangerous. So, what are supply and demand zones? So, supply and demand zones are a popular analysis technique used in day trading. The zones are the periods of sideways price action or consolidation that comes before explosive price moves. So normally a supply zone forms before a downtrend and a demand zone forms before an uptrend. So basically it's just the consolidation that happens after a run up or the consolidation that happens after the run down. So what's happening in these supply and demand zones? So during these consolidation periods, there's accumulation on the dip where you like to see like this same bottom getting bought every time and moving back up. And I'll go into that and show you a little image of what it means. But basically, what's happening in this accumulation phase is market makers are moving the float supply of a stock by buying. This process is called accumulation. So what they're doing is they're in a good zone that they like, that accumulation zone. They're picking up shares. They're getting ready for that move. They say, "Hey, it's about time." They're getting ready. They're getting ready, positioning themselves, and that breakout's going to come once that float supply starts to get low. And then the distribution zone is market makers will take advantage of the higher prices obtained in the rally to take profits by beginning to sell the stock back to uninformed traders or investors. And that's basically the dumb money like us, the retail traders, your everyday degenerates, the people that don't watch this video. They're the ones getting caught up in this distribution as that exit liquidity. So good way to visualize this is in this picture here. So you can see in the lower left hand side the accumulation or demand zone. So you see those multiple bottoms getting bought back up and kind of that chop in that consolidation. So that's an area where if you see a stock kind of continue to get bought up off that zone after a pullback, it's usually a good demand zone. And you can use that to start positioning yourselves for that breakout into the supply zone where that distribution happens, where you start seeing those multiple tops get hit, like your triple tops, your double tops. Those are all bearish indications that, hey, you might be due for a pullback here, and then you go back into reaccumulation, back up to distribution, and so on and so forth. And here's how you can take advantage of it. So you want to enter a position near the bottom to midpoint of a demand zone. So basically, that's just your support and resistances. So if a stock, let's say, was $100 and it constantly goes down to 95 and bounces back to 100 and 95 and back to 100, if you can start getting those positions in like that 97, 95 range, that's a pretty good area to get positioned with your calls, your stock, whatever it is you need. And then when it breaks out, so that 100 breaks and you get that close over 100, which you'll see me mention in like the due diligence I post all the time on Twitter, is that close over top of the demand zone is what can cause that trend up, that spike. So once you get that break, your options will get a lot of value added to them. And that's usually where like I like to make that trim. So you do a trim on the trend up, and then once you start seeing like, hey, there was a previous top, you want to start exiting in that mid supply zone or upper supply zone because generally there will be that distribution phase before the move higher. The break of the trend is where you really get that good bang for your buck in options because sometimes these moves can take days or even weeks to happen, but the first break of the trend up that might happen in a few minutes, a few hours if you get the timing right. Because if you get that bottom of the accumulation demand zone, spikes back up and through, your options could double, triple. It's really just all about the stock you're in, but the timing is important. So remember, when you're entering position, it's always good to get in the demand zone near the mid to bottom point, exit as soon as it breaks out. And here's just a really general view. So you can look back to previous durations in a stock. So you can see that wick down on the left-hand side there in the demand zone is the same as the fall breakdown, the small breakdown into the demand zone on the right. And same thing with the supply zone up top. The previous high was revisited again at a later date and it was in there for longer. So you can use multiple time frames to make these supply and demand zones. And there's a lot of different ways to look at it. But here's you can break it up. You can have supply zone here, demand zone here, demand becomes supplies, and there's really a lot of capabilities of what you can do with these supplies and demand zones. And you can also and a lot of them are referred to as just support and resistances, but you can do a little bit of analyzing here and just measure how long it's in these zones. So if the top zone, if it's there, if it repeats a lot, that's probably a pretty uh, strong area of selling. But if it's just a small second there, like in the middle supply zone, it's more of a weaker area. And over time, supply zones can become demand zones, or supply can turn into demand zone based on the trend of the stock. So you got to kind of be aware of your conditions, but support becomes resistance, resistance becomes support. It's all just dynamic with the market as things change. And here's another good example. So duration in the zone indicates the strength. So if you go up through a zone and it just goes, let's say that 9500 example, but it's inverse now. So it's going up to 95 or 100, and 100's the top. When it gets to that 100, it touches 100 and falls right out. That means that 100's a really strong zone and needs to be a news event or some kind of strong buying to get through. Let's say it gets up to like 99 to 100 in that middle bar and chops around up and down, up and down, and up and down. It's pretty strong, but the stock's not ready for it yet. And let's say it stays in that 9900 range for days or even weeks. That's telling you that it's getting ready to break. So the the duration in the zone indicates the strength. If you want long duration of those zones visited for breakouts or breakdowns. So that's where if you see stocks trending lower and they keep sending that lower consolidation, it's usually a bad sign and bearish things to come. But if they keep moving up higher in those higher and higher consolidations, it's usually a sign of bullish things to come. So I hope this video helped you a lot, kind of give you a little introduction to supply and demand zones. And there's plenty of other great resources out there. But if this is a trading style you're interested in, I hope this kind of gave you the tools to be successful. So with that, I guess I'll see you all next time.